Hey everybody, welcome to my first ever live Q&A, and this week we're going to be talking all about development finance. So guys, if you have any questions that you want to ask just to get ahead of the game, you can add those in the comments underneath. I will see those on the side of my page here, and I'll be able to actually add them in onto the bottom. Well, I should be able to, if all things go well. This is the first time I've ever done this, and I can ask them as we go along. But just to introduce myself, for those of you that don't follow me on either Instagram or YouTube, my name's Sam. I run a company called Grand Union Finance, and we are a specialist mortgage broker, basically, a specialist property finance brokerage that works specifically with investors and developers. We help those investors and developers raise buy-to-let mortgages, HMO mortgages, all types of specialist mortgages, basically, even up to commercial mortgages, as well as bridging finance, commercial finance, as I said, and the topic of discussion today, development finance. Now, I actually ran a poll on my Instagram yesterday, I think it was, or the day before, just basically asking people, right, I'm going to be doing my first ever live YouTube Q&A. What do you guys want to actually hear about? What do you guys want me to discuss? I gave 4 options, of which development finance was one, and that was the clear winner. In fact, I probably get asked questions about development finance more than I do pretty much anything else. And the reason I think that development finance is something that is something that people get confused about quite often is I think it gets lumped together with bridging finance quite frequently, and unfortunately, it's not bridging finance, people. It definitely isn't bridging finance. Bridging finance and development finance are two very different things. They both fall under the umbrella of short-term finance, but the reality of it is that development finance is a lot more complicated. So bridging is meant to be simple, okay? Bridging is meant to be quick, simple. There's lots of ways of speeding that process up through, making sure that the legal requirements are very minor. Indemnity insurance policies are taken out, in order to sort of cover off certain things that would need to be done by, say, a mortgage lender during their legal process to speed things up. And generally speaking, the underwriting is quite quick as well. And these sorts of lenders will have access to valuers that can go out and do the reports very quickly as well. So it's a quick, speedy sort of process. Development finance isn't. Development finance, the reason for taking out development finance is not speed and ease. We are trying to cover the costs, or we're trying to arrange finance to allow you to develop a site. That is actually the reason, the need for development finance, whereas bridging is generally for speed and flexibility. So although they fall under the same kind of category in terms of they are a short-term financial solution, they're not a mortgage. And in fact, mortgages are generally used as the exit strategy, i.e. the way that we would pay off these types of loans. Development finance is very much a specialist type of finance for developers, hence the name. So I think that's the reason why I think a lot of people ask me questions about it. The reason why a lot of the videos that I have already on YouTube are very popular when it comes to when development finance is the topic. And that is why, I also put a lot of effort into trying to educate people when it comes to development finance, because it is incredibly specialist. And so today, the purpose of today is for anyone watching, any questions that you have. This is a live Q&A. I am going to dip in with things. I have actually got some questions that people have asked via other social media platforms. So I'm going to I'm going to weave those in, but also I'm going to sort of just give my little snippets of knowledge on certain things, maybe give some examples of development finance options as well. So yeah, let's get cracking. So the first question that I got asked via Instagram, was a really good one. I'll read out the question, then I'm going to give it some context. I'm probably going to go back a step before actually answering this particular question. So Nikki on Instagram actually asked, Is there a way to get funding before you start the work and not after you invoice for said work? So that's the question. Can you get funding before you actually start the work? Let's take a step backwards and let's talk a little bit more about the structure of development finance first. Okay, so and again, I'm going to keep referring back to bridging as the comparable finance to development finance, because I think this is a really, really good way of being able to explain it, because people understand bridging a little bit more than they do development finance. So with a bridge is very much like a mortgage, insofar as you will borrow a certain percentage. In general, there are variations of this, but in general, a percentage of the value of your property day one. So when you purchase it, if the purchase price is 100 grand and the loan to value is 75%, you will borrow £75,000. Relatively simple. As I said, there are some variations of this, but you can also, because sometimes you can borrow against the value if that's higher than the purchase price and all that kind of stuff. And there are sort of refurbishment bridge products that go up to 85%. But let's just keep things simple for now, for comparative purposes. Development finance, you not only can borrow against the day one purchase price or the day one value if you already own the site, but the whole, the beauty of development finance is that lenders will also cover up to 100% of the cost of the renovation or the works. Yes, that I think bears repeating. Development finance allows us to not only borrow against the value of the property or the site as it is right now, the lender will also cover up to 100% of the cost of the work. So brilliant. This is why I love this product, because it really opens the doors to people being able to look at sites that they may never have been able to look at before, when they just thought that all they could do was raise a bridging loan against the value of the property as it is, or the value of the site as it is. So how does this actually work in practice? So what we're looking at here is we're looking at the instead of a loan to value, although that will come in later, how we work out the total loan amount is based on the GDV. Now, GDV stands for gross development value. None of this done up value stuff. I don't want to be hearing you talking about that. Thank you very much. Gross development value is the end value, is what the whole site will be worth once all the work is complete. And generally speaking, lenders can lend up to 65 to 75% of that figure. So if the GDV was going to be £1 million, the overall loan facility could be up to £750. Now, if you have to borrow £750 or 75% in this instance, generally speaking, I would question how good the site actually is, or how good the project actually is, because if you need to borrow 75%, that says to me that there probably isn't a huge amount of profits in that particular site. So we're borrowing up to a certain percentage of the GDV. Now, this then gets split into two separate aspects of this loan. Okay, so we've got one aspect that covers the cost of the works, and then we've got another aspect that covers the day one purchase price, or an amount that is secured against the value of the site as is right now. We call that our day one net advance. Okay, I'm going to cut through a lot of the jargon on this video as well. So first of all, let's talk about the development facility. So we have our overall facility. Think of it like an umbrella with two people underneath, and one person is the development facility. This covers the cost of the works. The other one is our day one net advance, and that is what is secured against the asset day one. Okay, so let's talk about the development facility next. Development facility will cover a few different things. Number one, of course, what they want to do first and foremost is cover the cost of the works that are going to be done. Now, a lender's going to want to actually cover all of those if they possibly can. There's a very, very good reason for this. Think of it from a lender's point of view. They are unlikely to get their money back until the site is complete. They need to know that you have the ability to complete the site. And one of those things that will allow you to complete the site is to have the available funds. So the logic in that is that they do actually want to cover all of the cost of your works if they can. So their preference will be to cover that. even if there isn't enough left in the overall pot to cover the purchase price. They would prefer you to cover the cost of the purchase price and for them to cover the cost of the works. So that's what they're going to look at first and foremost, cost of works. So if that was 200 grand, let's say, they're going to cover their £200,000 first and foremost, go straight into that development facility, right? So now then on top of that, they're going to add a contingency. For any of you that's watched Homes Under the Hammer, Grand Designs, anything like that, you will know development sites always go over budget. In fact, I love Grand Designs, absolutely love Grand Designs. But one thing that I always find amusing, and one thing I always track, and I'm pretty good at getting this right as well, in terms of how much I think they're going to go over. My wife is always very, very impressed about how I'm like, yeah, if he said 300 grand, that's going to cost 450, I reckon. And then it comes out slightly, very, very similar, and I'm always have like this smug look on my face. But it always goes a little bit, you don't know what's going to happen. People that started work on something at the beginning, just before the first lockdown, for example, obviously having to sit around, maybe pay extra money on to keep builders, sitting there waiting until they can go back on site, all this kind of stuff. It all adds to your costs. So lenders will want to add a contingency into your development finance facility. Typically, this is 10%. So if it's 200 grand, that's going to be £20,000 that they're going to add on. So we're already up to 220,000. They're also going to add in what they believe, and this will get more sort of finite as the application process goes on, and we'll talk about the application process later on in this video, because it's very, very, very particular and quite different to a lot of the other types of finance that we're looking to arrange. But typically, if say for example you're taking out about an 18-month term, so you probably would look at an 18-month term if you were looking at doing something like building a couple of houses or something like that. 18 months is probably enough when you're doing a project like that. So what they'll look at is, because they're gonna the funds that you borrow through or you draw down from your development facility are done in stage payments. You actually only start paying interest on the funds that you draw down as you draw them down. So when it's sitting there in that facility, you're not paying for it, which is actually one of the beauties of development finance as well. So if we had our £200,000 cost of works, by the way, thanks T Changa, good to have you on board. If you have go back to what I said before. So you've got, let's say we have 5 stage payments of that £200,000 or £50,000 each. Once you've drawn down that first 50,000, that's when you start paying interest on it. So at this moment in time, even though the term's 18 months, and the lender's going to want to add in the interest that you're going to pay into that development facility, because again, this mitigates their risk. They know it's paid, it's in the facility then. They're not reliant on you having to pay it further down the line. It's there ready, okay? So it's all about lenders' appetite for risk on this kind of stuff. So what happens is they will have to, at the beginning, kind of just make a bit of a judgment call. So typically speaking, if it's an 18-month term, they'll go, okay, so they're going to draw down the first sort of 50,000 about this sort of time, second 50,000 about this sort of time, etc., etc. So it's probably going to be around about maybe 10 months worth of interest in total for this facility that they will use, and they'll chuck that in. Now, further down the line, they may sort of make this a little bit more specific once we move through the process, but we'll just talk about how we arrange it to start with. So that will be thrown into the development facility as well. Okay. Now, the last thing that will go into the development part of our facility, don't forget we've got our development facility, we've got our day one net advance that comes in under our overall loan facility, is going to be the cost of the site visits that the surveyor is going to go and do throughout the course of the work. So don't forget that the lender's not just going to take your word for it, unfortunately, when it comes to, right, hi, Mr. or Mrs. Lender, we've done our first little bit of work. Can we have our next tranche of funding, please? Oh, yeah, of course you can, Mr. Developer. No problem at all. There you go. No, it doesn't work like that, unfortunately. What they'll be doing is they'll send an official surveyor, what we call a quantity surveyor or an asset manager, depending on the lender. They'll have either somebody that they will use from sort of a third party, or sometimes they'll have an in-house person that goes and does that. For various regions around the country. and they will send them out in advance of giving you that next tranche or stage payment, and they will give the thumbs up that everything that we planned to have happened has happened and been paid for, essentially. And so they'll work in the cost of those visits as well. When we come to talking about the application process in a sec, we'll talk a little bit more about quantity surveyors, but typically speaking, those visits can cost up to sort of £750 sometimes a time. So if we've got 4 stage payments, that's 4 lots of that we also need to work into our development finance facility. So just to recap, development finance facility, in there we've got the cost of the works, we've got our contingency, typically of 10%, we've got the average sort of estimate of interest that's going to be paid on that amount, and we've got enough there to cover enough site visits from the quantity surveyor or asset manager to cover all of the stage payments that we need. So that then comes out of the total, that umbrella total loan facility that we talked about. So our one person over here, the development finance facility, that comes out of that first. Whatever remains can then go towards the cost of the purchase of the site, or if we've already purchased cash, what we call a day one net advance. Now, if, say, for example, the cost of the purchase or the purchase price of the site was 100,000, just to keep things nice and simple, and there was 150,000 pound left in the pot after we took out our development finance facility from the overall loan facility, they're not just going to give you 150,000, because it's got to be secured against the site, and it's got to be based on a loan to value, very similar to a bridging loan or a mortgage. Typically speaking, lenders will go up to 70. Some lenders will go up to 75%, but really the standard for the industry is 65 or 70%. So if it's 100,000, out of that 150 that remains, they'll give you 70,000, 70% of the purchase price towards the purchase. Okay. Now, obviously, you're then probably thinking, okay, well, originally we were going to have that loan facility. It was going to be, say, 65%. But now you're saying, well, we've got our development facility where we can only borrow 70% on the day one, which comes in less than that overall loan facility. So what happens there? Well, we just reduce the overall loan facility down to whatever those two actually are. The lender will say, well, this particular development finance product can go up to 65% of GDV or 65% LTGDV, as we would call it, as the abbreviation. But that doesn't mean that we have to go all the way to the top. In fact, sometimes the site won't allow us to. And actually, the lower the loan to GDV that you go to typically shows how the site is pretty good. Because if you think about it, if the GDV is up here and the cost of the acquisition is very small and then the cost of the works is quite small, that difference is profit. So the difference between the overall loan that you're taking out and the GDV, the bigger that is, the bigger your profit margin, the better the quality of the site. Little tip for you there. Hey, Jocelyn, thank you very much for saying hello. Good to have you on board. Just to interject, people, I'm currently going through a question that was asked on my Instagram yesterday. But if any of you have any questions that you want to ask specifically about development finance, or developing in general, or anything like that, or to be honest, if you want to chuck in a couple of little property questions, if you are interested, just chuck them in the comments. I can see them on my screen, and I can actually answer them as we go, which is good. In fact, I think just so I can test this, I'm going to put Jocelyn's little comment just saying, hey, I think I can put it on the screen. There we go. So if you ask me a question, I can actually put it on the screen and we can all chat through it. So brilliant. Okay, so I've given the kind of the overview of how development finance is actually arranged. Let's get back to answering this particular question from Nikki from Instagram, which was, is there a way of funding before you start the work? So this brings up a really, really important part about development finance and not a lot of people realise, which is those stage payments that I talked about, our development finance facility. I'm doing my hands the wrong way around because this camera turns it around, so everything's the right way around. But the development finance facility that we had, don't forget, we've got our overall loan facility, we've got development finance facility, and then our day one net advance. The development finance facility, the stage payments are made in arrears. Now, what that means is if you've got 4 stage payments of 50,000 because the overall cost of the works is 200,000, what actually happens is the lender will want to see that you cover the first stage payment. So in this instance, 4 stage payments of 50,000, you will have to do the first £50,000 of work out of your own back pocket, and then they will reimburse you. So it's do the work, reimburse. That money gets used for the next bit, finish that, then it gets reimbursed. Third part, finish, reimbursed. Fourth part, stage payment reimburses you. So they will lend you the full 200,000 in the end, but it's done in arrears. So you have to cover that first stage payment. So what Nikki's asking on this question is there a way of getting that to be paid in advance? Now, no, there isn't, unless, of course, we've got other assets that we can bring into the equation. So one thing that bridging is development finance is similar to bridging on is that you can actually borrow against multiple properties if you need to. So adding extra assets that have equity into them would allow you to increase that day one net advance. So this is why I speak to a lot of clients and they say to me, Sam, I've already actually bought this site. I bought it cash. So I now just want to borrow the development finance. So we're going back to what this example, the development costs are going to be 200,000. I just want to borrow 200,000. Well, I say to them, well, hey, have you got 50 grand lying around? No, we haven't. Okay, great. So what we'll actually do then in that instance is we'll borrow 250,000. Now, it's not ideal because the less we borrow, the better. I bet you never heard a mortgage broker or property finance broker say that. The less you borrow, the better. We get paid on how much you borrow. In theory, we want you to borrow as much as possible. But, the less you borrow, the better. But in this instance, to make it work, what we can do is we can borrow the 200,000, don't forget, 4 stage payments paid in arrears. And then what you do is you borrow 50 grand against the site day one that you own cash as our day one net advance, because I'm sure that will be well within the loan to value. And it means you've got the money there to cover that first tranche. If you're not in that position, then you will have to find that money elsewhere. So just to recap on that question, the stage payments on development finance are made in arrears, okay? And to try and see if we can mitigate that, if you like, what we do is we can either, if you bought the site cash, we can borrow a percentage of that day one to cover the first part of the cost of the work, so that you're not out of pocket. Or we can add other properties into the mix. And unless that is the case, unfortunately, those funds are made in arrears. The lender wants to see that you are putting skin in the game, if you like, whether that's in cash or whether that's in equity in other properties. So that's essentially how it works. Okay. So sorry, Nikki, it doesn't quite work like that, I'm afraid. Right. Quick little coffee break. Hope you guys are enjoying this so far. I certainly am. I love doing live videos. I actually do a live Q&A over on my Instagram page, which you can see scrolling across the bottom. If you don't follow me on Instagram, at the Sam Norris, I just realised I've spelled that wrong. So let's go and change that whilst we're doing that. Actually managed to spell my own name incorrectly. There we go. Let's see if it's working now. There we go. At the Sam Norris. Obviously, I was doing that too quickly earlier on. But yeah, I'll do a live Q&A over on my Instagram page every single Monday at 5 p.m. We call it the Monday Mortgage Melt. You can also listen to it the next day, as long as Instagram allows me to download it, over on my podcast, which you can see up here. It's weird because this is doing it the wrong way around for me. The Game Alone's podcast. In the description underneath this video, you should be able to find a link to both of those as well to go and check those out. So let's get back to talking about development finance. If you've got any questions, put them in the comments on this video. I will answer them as we go. But let's talk about the process now of actually applying for development finance, because it's very, very different to applying for, say, a mortgage or a bridging loan. There are similarities, of course there are, because there's a lot of, especially on the bridging side, there's quite a lot of overlap between lenders that do bridging and development finance. There are more lenders that do bridging and then they also do development finance, rather than those that specialize in development finance and then also do a bit of bridging. It's generally, the sort of entry level development finance will come from bridging lenders. So what do we have to do first and foremost? Well, first and foremost, we need to appraise the site. Before we even go anywhere near a lender, we need to do a bit of appraisal. We need to look at what the cost of the purchase of the site is going to be, what the cost of the work is going to be, the GDV, and what our exit strategy is going to be. Once we have that information, we can do a bit of analysis using sort of basic assumptions on costs of, say, solicitors and that sort of stuff. We can do a very, very basic site appraisal because what we're looking to figure out is roughly how much money are you as a developer going to have available to you to make this work on a standard sort of development finance type arrangement. If you don't, there are things that we can do, and we'll talk about those a little bit later on. That'll be another topic for discussion. If you don't have enough money on standard development finance, what do you do? We just want to know how much money you're going to have to put into it and what the profit margins are going to look like at the other end, basically. So once we've done that, we've got a tick in the box, right? We know that it works. We then have to put together a funding proposal to send over to the lenders that we think are going to be the best suited, based on your experience and how much you want to borrow, where the site is, that sort of thing. So to do this, generally speaking, lenders like to see a few different things. They want to know about your experience. Your experience is probably the most important thing. In fact, there's probably 3 things that lenders want to see, and I'll go through them in priority order. Number 1 is your experience. In terms of this particular project, have you done anything like this before? If you haven't done anything like it, have you done anything similar or at a lower level? What kind of experience do you have as an individual that you can give the lender comfort that you're going to succeed on this project again? So hopefully you do, and we can provide them with, we've got a template document we call a previous project schedule, and it just basically gives the basics of previous projects you've been involved with, either as the principal developer or as a builder or a plumber or whatever it might be. That can also go towards your experience, because of course you were involved with those with those projects. So that's the first thing that we want to put together, and a detailed overview of your experience. Give the lender a thumbs up. We then also want to give them an idea of the assets that you currently own, because it shows the strength of your financial situation. Basically, lenders, the more assets you got, the more experience you got, the more comfort a lender's going to be with working with you, and the more likely we are to get them to say yes, and then give us really, really good terms as well. So that's the next thing that we look at. So an assets and liabilities spreadsheet is the standard way in which we can go about doing that. It gives a very, very quick snapshot as to your current financial situation, what your net worth is, and how many assets you've got. We can also provide them with a property schedule, so basically an Excel spreadsheet with all the details of all the properties that you currently have in your portfolio, if you have one. Last on the list, but still very important, it's just what your income situation is, both in terms of maybe employed income, self-employed income, or property income. We want to give the lender a detailed overview of that situation so that they know that you have resources, you have access to money if something goes wrong. Okay, so I had, for example, a client who had no experience, had no assets other than their own home. And I managed to get I convinced the lender to lend to them on development finance for the first development they've ever done. And it was a relatively reasonable development site on the fact that they had a very, very strong surplus income. They had an income of 6 figures, in excess of 6 figures, and their outgoings were very, very low. Therefore, they had a huge surplus each month, which gave the lender, a lot of comfort that if something did go wrong, they would have access to some money to be able to actually go and look after the site, basically go and sort things out. So they're the things that we want to be showing to a lender, in addition to details of the site. We show them, where the site is, what the plans are, linked to the planning portal if there is one, usually a Google Maps link as well. If we've got any plans, details of what's going to happen, a schedule of works, a list of all the work that's going to be going on with the costs. And then information about what the GDV is likely to be. Once we've got all this together, we can send this over to a lender. Now, that might sound quite extensive, and I do know a lot of brokers that don't give that level of detail when inquiring with a lender for the first time. Now, obviously, if there's something very specific that's weird about the situation, we'll just get on the phone and have a quick chat with these lenders just before we send anything more, more advanced to them, just to make sure that they're happy with that particular point. But the funding proposal should be of that sort of level, because we want to get something over to a lender who can then go, actually, this looks really, really good. we're going to be happy to lend on this. These are the terms in which we're happy to lend on, and they're unlikely to change because we've given them all the information they need to make a really good decision very early doors. So we do that. We then get sent what's called heads of terms. Now this is a credit-backed term sheet specific to your site and you to say, as long as everything you just told us is correct, we are going to lend on this, and this is how much we're willing to lend. If we're okay with that, generally speaking, it's a case of getting those signed and back over to the lender, together with like a full application form and our underwriting documents. Now, these tend to be what we call our KYC documents, know your client documents, which is ID and proof of address. So we send those over. And if they want to see things like proof of income, some bank statements, all that kind of stuff, we can send those over as well. But they usually want to see an assets and liability statement, portfolio schedule, but we probably have already sent these to them. So as you can see, we're kind of doing things in advance as well. It's at that point that we kind of consider that the application is submitted. Underwriter's got hold of it. The first thing the underwriter's going to do is just check through everything first. Now, with a bridging loan, generally speaking, what they'll do is as soon as they get it, they'll instruct a valuer. With development finance, they're not trying to be quick necessarily. They're trying to do things properly. So they will probably look through the documents and the application first, just to make sure that that matches up to what we spoke to them about and what we sent over to them in the funding proposal. And that's where we will then get the thumbs up that they're happy with everything. And that's when we will get a survey instructed. Now, this survey that we get done first is very similar to what will get done for a bridging loan. It's going to be more expensive than what we would do for a mortgage, but very similar to what we do for a bridging loan. What we're asking the surveyor to do is to go and let us know what the site is worth now, give us an indication of the GDV, and give us some market analysis, basically. So if we're looking to sell the site at the end, give us some market analysis of that. If we're looking to rent the site at the end, some market analysis of that. Now, once we've got that back, as long as that's all okay, we then move on to the next section. This is where it really starts differentiating itself from the application process for a bridge or a mortgage, because a second survey is then instructed. And this is where we get our quantity surveyor involved. You might have heard the abbreviation QS. That stands for quantity surveyor. The quantity surveyor will get sent out to the site. Generally speaking, they're going to meet with either yourself if you're project managing or your builder or project manager to go through the schedule of the works. Okay, so what needs doing, when, and how much is it going to cost? Now, the quantity surveyor then puts a report together, and what they're actually sending back to the lender is how long they think it's going to take, because they might have a differing opinion to your project manager, and how much they think it's going to cost. Now, what they're costing, and this is where a lot of developers get a bit annoyed, because a lot of developers might have really good relationships with certain trades or whatever it might be to get materials, and might be able to do things themselves, at cost. And so therefore their cost levels might be here. But actually, if we went out to tender, which means if we actually went to the open market and got a completely third party entity to cover, to do all of the works and project manage, if our costs are going to be there, they might actually be up here. The lender needs to know what it's going to cost if they have to go out to market, because if something goes wrong throughout the site, you get run over by a bus or I shouldn't laugh, that's horrible. But if you get run over by a bus or whatever, you're not around and they have to take over the running of the site, they might not have the same kind of access that you do to all of this stuff. So they'll work out the cost of the funds based on the open market value of the cost of the funds, if that makes sense. What would happen if you had to go to market and actually get complete third-party company contractor to come in and run the entire site? Now, they will then base their loan on that because they want to cover it. You do not have to draw it down, people, okay? The only issue that's going to cause us is if it takes us beyond the loan to GDV, and it means they can't lend this. They'll probably take that off the day one, net advance, as a result. So that's what will happen. The QS, the quantity surveyor, come back and value the works, and look at how long it's going to take as well. And that information will then potentially change the terms based on that information. So don't forget, the lender is looking at what the cost of the works is likely to be if it just went to a third-party contractor, not necessarily how much you can get it for. And the terms will be changed as a result. Now, as long as that's all okay, they'll send out a final sort of non-binding offer. which will sign again, and that's when it goes into legals. And that sort of situation is very similar again to bridging or mortgages. They'll have to do searches and all this kind of stuff in order to move this through. Sometimes if you're buying it, they might need information from the seller, and sometimes when you're even if you're refinancing, there'll be a lot of inquiries that your solicitor will be required to cover. Now, it's very important on this point to hammer home that you, for anything like bridging finance, development finance, commercial mortgages, you actually need to get a very specific type of solicitor involved. You can't just go to a standard conveyancer. You need to go to a commercial solicitor, a commercial conveyancer, somebody who has access to or understands this type of funding, because the kind of questions they're going to be asked are not going to be what a standard conveyancer is used to being asked, and they probably won't know how to work that. So we have to be quite specific in terms of who you work with. Find someone with a lot of experience. I've been quite fortunate over the years to work with lots of really, really good conveyancers who have access to this type of knowledge. So if ever you guys want a recommendation, please send me a direct message on Instagram at the Sam Norris, going across the screen at the bottom, and I'll be happy to put you in touch. And that's that. We then complete and we're good to go. So that's the application process. Now we do have a question that's coming from Norris Dibs. So I will get that up on the screen now. There we go. Let's see how we do this. Perfect. Look how beautiful that is. I hope you're all enjoying this, by the way. If you've got any questions, like Maurice, just chuck them into the comments below, and I will get around to answering them. Coffee's starting to go a little bit cold. I think I left that a bit too long. Hi, Sam. Can I ask if it is possible to take out development finance partway through a build or conversion on an unencumbered site? This is a great question. The very short answer to that is yes, it is. However, lenders are going to, and I've had this situation before. So what a lender will look at is, why are you coming to us now? Why didn't you come to us at the beginning? And I've had situations where lenders, they kind of, it sounds like I'm going to sound like, oh, lenders are really untrustworthy. They kind of are, but it's through experience. They're not untrustworthy. They are not, they're just not trusting, if that makes sense. They want to make sure everything's above board. Now, if you're going to them halfway through a build, they are going to kind of go, did you completely bugger this up? In terms of, yes, T Changa, it is a very good question. Did you basically bugger this up? Did you do a grand designs? Did you put aside 300 grand and it's now costing you 450 grand and you suddenly need more money? They're going to want to know why. Okay, so we need to be prepared for that. It is entirely possible to get development finance part of the way through a build or a conversion or whatever it might be. I mean, particularly if it's unencumbered. If you're just quickly before I sort of carry on with this, Maurice, if the site is not unencumbered, i.e., by the way, unencumbered for those of you that don't know means that you don't have any finance attached to it currently. If you do, we would maybe have to get like a sort of a second charge type arrangement for development finance. It's called mezzanine finance or junior debt. Or we speak to our existing lender and say, look, we need a little bit more. And if there's a little bit more in the tank allowed, they may well lend it. But typically speaking, they would have sent out their quantity surveyor at the beginning, like we were talking about earlier, and the cost of the works would have come back at 300 grand in this example. And they're going to go, well, you've just buggered this up, I mean, look, they want to get the site done as much as you do because it's in their interest for that to happen as well. But we need to be wary of that, the fact that they are going to be a bit suspicious about why this has not happened, and maybe don't want to lend to you because that maybe shows a lack of experience of the fact that you've started this build and haven't been able to complete it within your budget. So it shows a lack of, or either a lack of understanding from yourself or experience from yourself, or your project manager, contractor, they're still on site doing it. And if one or two problems have arisen as a result of them, then what's to say there isn't anymore? Now, I'm not trying to be negative about this. It's I'm saying all of this as a heads up more than anything else. I think it's really important that we know what is going to be required of us. I've just gone through the process of an application for development finance. but we also need to understand, what we would have to do on top of that if we were in this situation. I reckon in the last year, I've had 4 or 5 separate individuals that have come to me with this exact problem. And every single time the question has been exactly the same from a development finance lender, which is, why are they coming to us now? And generally speaking, it's because it has gone beyond the budget. Or, there was the most recent one that we looked at. The client came to me and said, hi Sam, we've exhausted all of our money. So now we're looking to get development finance. But my first thing was, you should have had this arranged at the beginning. So even if you could show that you're going to buy this site for 100 grand, the cost of works was 200 grand, and you had, let's say, 200 grand. So, i.e., you would need 100 grand. The best thing to do is get that arranged at the beginning. So you can draw it down later on when you need it. Or don't draw it down if you don't need it. I think what a lot of the clients that I've spoken to that have been in this kind of situation, what they kind of say, we didn't want to, pay all the fees at the beginning where we wasn't sure if we'd actually need it. Well, you do know that you're going to need it, and paying fees, paying solicitors' fees and whatnot. These things, legal fees, valuation fees, they're part and parcel of these applications. And I always find it funny when clients go, that's very expensive. And I said, expensive is comparative. And if you're looking at doing development finance, expensive compared to a mortgage, yeah, but we're not comparing it to a mortgage, don't forget. There's a lot more involved. It's very specialist finance. In fact, I would probably say that development finance is the most sort of specialist finance you can get. It's even more specialist than commercial mortgages, to be quite honest with you. Probably commercial development finance is probably the most specialist property finance you can get, I would imagine. But just development finance on the whole is that sort of top of the tree, probably the most complicated. So complicated. Thanks, Maurice. Yeah, good. I'm glad this is being helpful. So we have to we just need to be prepared for those questions. No matter what type of finance arrangements we're looking at putting in place, whatever kind of application we're putting in, development finance or anything else, it's always about being proactive, knowing what is going to come at us and having questions answered before they're asked of us effectively. And this is no different. So question is going to be, why are you coming to us now? We need to have a story. Now, as I said, before we go out and do this, for any of you watching this, probably best to get it sorted out at the beginning and not use it if you don't need it. In the last instance that I just used as an example, they knew that they were going to need it at some point. They just waited until they needed it. The problem was, is that at that point, it was, okay, well, now you need 100 grand and the site is worth X. So actually, theoretically speaking, we could probably go for a bridging loan on something like that if that would cover the cost of the works. We just get it all in one and we get it done. Which kind of actually opens up another example here of, a lot of people when they're looking to exit these development sites, there is actually, a lot of my clients, they're always actively looking for sites. And when you're going through the sort of the exit stage, when you're selling off your units, let's say you built 10 houses, and you might have sold 3 of them, another 4 are going through kind of the legals or whatever, and you still got a few on the market. And then this other development site comes up, and you're thinking, oh my God, I really want to purchase that. We can actually do what we call a development exit loan on this, where we actually kind of refinance to a degree the development finance that you've got on your current development, and use those developments as security, as well as the new site as security for kind of like a bridging loan. It's almost like a development bridging loan to bridge the gap between selling your current site and buying the next one. And we do quite a lot of that actually. So it's like it's a way of you being able to access and purchase that new site without waiting for everything to be sold on the other one. And that's generally a way of sort of getting out of this as well. So it's always good to know. T Chango has asked, I think it's one of those situations, I think it's one of those situations where it can be easily avoided from the beginning. Absolutely. The earlier you do this kind of stuff, the better. And this is a great example of that. The quicker you get in, the earlier you get in. One thing though, look, if you're in a position where you can purchase cash, that's great. However, when you are getting development finance out after you have purchased the site, generally speaking, most development lenders won't be comfortable actually putting the or securing the loan against the site until they can actually see on the land registry that you own it. I mean, at the moment, that can be taken up to 6 to 9 months. So you might be cutting it fine in terms of actually getting access to that cash if you choose to start the process after you actually purchase the site. Because you might have to wait 6 to 9 months for land registry. Now, I know you can expedite the land registry registration process by proving to them that there is a finance application involved in this, and it's being delayed because of land registry's delays. But even so, something just to bear in mind, I think, when looking at this. So really good question. Thanks, Maurice. If any of you have any other questions, please drop them into the comments. I'm happy to answer them. But I thought I would also go into a little bit of detail in terms of just talking about sort of different types of lenders, really. So different types of lenders depending on different situations and stuff like that. So if you are, remember we were talking about earlier, we had our 3 kind of things that lenders were looking at. They were looking at experience, they were looking at assets, they were looking at income. Okay. So if you fall short of one or all of those, it's obviously going to reduce the number of lending options that we've got. So we're then going to have to go to lenders that might cost a little bit more. And I get a lot of questions, a lot of people saying to me, it's unfair that, or it's annoying that I've got to pay more than, Johnny down the road who's done a few of these sites before. And I said, well, look, it's all relative. You only have access to these lenders because you don't have the experience. In order to get the experience, you need to use these lenders, go through the process, get the experience of actually working these sites. Doing these development projects is not just about money, it's about gaining the experience of doing them as well, because it will allow you to have access to better lenders as we move forward. And typically speaking, it's not an exact kind of straight line, but effectively the more experience you've got, the more access you've got to more lenders, better lenders, and typically, better interest rates and stuff like that. I know Norris has come up with another question that I'll jump on in a second to do with interest rates. But also, and this is something, the bigger and the cheaper development lenders, actually, it's not like bridging where it's just a case of, right, you can access more bridging lenders, cheaper bridging lenders, whatever it might be. It's actually, these development finance lenders are cheaper. They'll only work with experienced developers, and they will also cap your loan to GDV at a much lower level than some of these other lenders will be. So effectively, I talk a lot about the bridging triangle. The development finance triangle is just as relevant, which is we've got 3 aspects to choosing a lender, okay, which is price, speed, and flexibility. They're 3 corners of a triangle. Now, we're not going to be able to get all 3, because if speed is our most important factor, then we've got to remove flexibility and price from the equation to start with, and we've got to work with lenders that have access to a process that is quicker than the average. So this would come into play, for example, if you're organising a bridging loan for an auction purchase. Speed becomes the most important thing. The other 2 are less important. Now, if you don't have a lot of cash or you don't have a lot of experience, so therefore you need to go to a lender that will lend to someone with not a lot of experience, and they will lend a higher loan to GDV. Flexibility is our most important corner of the triangle that we need to focus in on. And the other 2, speed and price, become secondary. You kind of see where I'm going with this. So once you've got lots of experience, and once you've got cash that you can put down, so you don't need flexibility, speed is not an issue. It's only then that we then look at price as our most important aspect. And this would probably be quite a good idea to then bring in Maurice's second question, which is what are the typical rates and fees on a development finance facility? So as I was saying before, this can vary depending on which corner of the triangle we're working on. But let's talk about the different levels. If we're looking at an entry level development finance lender, we could be looking at 1% a month in terms of an interest rate. Typically speaking, fees are going to be somewhere in the region of 2% from a lender's perspective. Valuation costs can vary dramatically. Don't forget, we're going to have to be looking at the cost of a standard survey and then a QS going out as well. Standard survey could be, 1,000, 2,000, 3,000, depending on the value of the site. Generally, it goes up higher and higher depending on the value of the site, because the site value is covered by the surveyor's PI cover. It's their public liability cover, basically. And they can only do certain levels of sites. So the higher it goes, the more the cost is. And the quantity surveyors, as I said before, typically could be 500, 750, 1,000, 2,500, 2,500, no, 1,200. That's what I was going at. Something like that could be the cost of that. But interest rate wise, we're just going to solely looking at interest rate. Entry level, probably looking at somewhere between 0.75% and 1% at the moment per month. That's probably pretty average. We go to kind of the next level down are kind of ones that are not quite, they won't necessarily lend to entry level, but they're not like your high street lenders just yet. We could be looking at 0.65%, maybe 6 to, or let's just say maybe something like 7 to 8% per annum. Roughly those kind of figures. And then we've got our top level, our best development finance lenders. Now they're going to have lots of restrictions. Experience is certainly going to be one. Asset base is going to be another. Availability of funds yourself to put into these deals. They're not going to go to 75% loan to GDV. They might just go to 50% loan to GDV or 55% loan to GDV. They are going to expect you to have lots of cash behind you. They'll do it. But they will probably, then they'll do it at maybe 6%, 5.5%, 6% per annum. Really, that's pretty cheap. I have seen development finance lending for as low as 4.5%, 5%. But these are lenders that they'll have minimum loan sizes of maybe £1 million, £1.5 million. So we're talking about big development sites. So you've got to work your way up to working with those lenders, and I see that partly as one of my jobs as a broker. With my clients, I have to help them navigate up to the point where they can access these lenders. And when I speak to clients where it's their first ever site, what I'm saying to them is, look, it's time for at the moment the time is right for access to these entry level development lenders. But as we scale, as we move up, as we grow, how much cash you've got available, your experience, your asset base, all these things, then we're going to have greater and greater access. It's my job to help you navigate that ladder effectively. Hopefully most of them get that. I think some of them do get annoyed sometimes at the beginning, because the property development community is very tight. There's lots of people willing to give advice, and lots of people online chatting about property and what kind of finance arrangements they have. And sometimes it is difficult because you're comparing yourself to somebody that has a lot more experience. And what I say to these people is, we'll get there. We will get there. They were in your shoes at one point. They were using these types of lenders for their first, second, third time. So it's important to know that you've got a path. You've got a path to follow, and we know that we're going to get there. We've just got to take it site by site. And each site we do, the situation might be slightly different, and we might have access to a slightly different lender, a slightly better lender. I'm not going to say better, because actually some of these entry level lenders are great because they're flexible. From my perspective, the access we have to the decision makers is great, because they're generally smaller operations. When we get up to the top level and we're working with high street lenders, they're just wait. They're quite happy to say no quite easily. They don't need to lend to you. Whereas these sort of challenger lenders, these entry level lenders, they're really hungry to lend this money out, and so they will be flexible. They will give us there'll be smaller operations. They will give us access to directly to underwriters and whatever it might be. They'll be more flexible with certain things. So it's it's massively and do you know what? I've actually still got lenders. I've still got clients that, even though they've got experience where they could potentially access slightly different lenders, they still go for these types of lenders because they like the way that they work. They've supported them, and they know that they're going to get the job done. So I've got clients that are 10 projects in and they're still using lenders that are costing them 9% per annum, because they know that they're getting a great service. That particular lender maybe has worked with them previously, all that kind of stuff. Their solicitors work with them as well. It's worth maybe sometimes paying a little bit more to getting a slightly better service. And this is important as well, because if you do access the top level development finance lenders, they're not going to be quick, they're not going to be accessible, they're not going to be flexible. Yeah, they're going to give you a good price, but my God, they're going to make you jump through hoops in order to get it. The paperwork will be a lot more extensive, and ultimately they won't lend you as much, probably, in terms of on the percentage side. So you have to take all of this kind of stuff into account. When I talked, and this is why maybe we're coming sort of full circle to what I said at the beginning of this video, which is that development finance is a very, very specialist type of finance. It is not like bridging, and it's certainly not like mortgages. Mortgage lending is very, very straightforward and simple. And even from the point of view, it doesn't need to be. Sometimes it can be quite tricky with finding the right criteria and all that kind of stuff. But essentially, brokers have access to term sheets, product guides, criteria guides. They have access to the lenders to talk to them about these kind of things. We have search engines to give us data on what products are available for certain types of things, and how much it's going to cost. But we don't have that for development finance. So all of this kind of stuff is very relationship led, and even from a borrower's perspective, you do start working with certain lenders, and you build up a reputation with that particular lender in a positive way, and they might even start giving you some breaks at some point in terms of costs and things like that. So there's lots of things to take into consideration. It's not just about the price. There's all these other things. It's that development triangle that I spoke to you about earlier on. It's the price versus the flexibility versus the speed, which is the most important. Put those in order of priority, and let's find the lender to match that matches up with then your experience, your asset base, and your income. So you can kind of start seeing, there's some familiar themes here. But cool. Cool. Look, I think we're starting to get to the end. Unless anyone's got any last minute questions, we'll start sort of wrapping things up. So hopefully this was really, really helpful. Look, this will be on my channel for you to watch back if you are coming in late. It will also be the audio will be on my podcast. Other way. There we go. The Game Alone's podcast, which you can find the link in the description below to go and listen to. Was this helpful? Hopefully it was. I'll probably do more of these videos on a more regular basis, so discussing specific topics. Obviously today was all about development finance, but certainly in the future we can have discussions on bridging finance, commercial finance. We can talk about how we would get mortgages for social housing things, or social housing strategy for serviced accommodation, for HMOs. We can talk about the basics of buy-to-let mortgages. Where there's a whole plethora of different opportunities, different topics we can discuss. So if you are watching this back, or if you're watching it live now, any ideas you have for future topics, drop them in the comments, and I'll take those on board when choosing a bit of a schedule over the next couple of weeks. Just as a heads up though, guys, I am going to be starting to do a lot more lives. So actually I have guests on board as well. The first guest, we're just sorting a date out at the moment. The first guest that I'm going to be coming on my new live show, Show Me the Money, where we talk about sort of non-property investment stuff. We're going to be talking about how to make money, earn money, invest money, how money, what money actually means. My first guest is going to be the amazing Lewis Harding from Lewis Harding Invest. He is a published, in terms of he's been had articles in the Financial Times talking about how to invest your money in the stock market. Old school stuff here, people. I can't wait to get Lewis on to chat about that, because obviously at the moment you don't want your money sitting in a savings account. It's not going to be making much in there. So Lewis is going to come on sometime in the next week or so. We're going to be discussing, and I'll make sure that I advertise this over on Instagram exactly when this is going to be. But stick your notifications on when you subscribe to my channel, and you'll get a notification when I put that video up in advance, as I did with this one. It will have a sort of a premiere date where you will be able to sort of then click a notification to be told when we are going live. But Lewis is going to come on for my new show, Show Me the Money, over the next week. Jocelyn, great live, Sam. Thanks as always. Very interesting. Good to hear. Cool. Well, look, the sun is shining. It is definitely shining. I didn't put my ring light up. It's not a very professional operation here. Sorry, people. So I'm going to enjoy a little bit of that today. Hopefully you guys do too. And don't forget, as I said, if you've got any other questions or anything to do with whatever we discussed today, either drop them in the comments below. I reply to every single comment that I get, or send me a direct message on Instagram. You can see my Instagram handle on the bottom, flowing along at the Sam Norris, and I'll be happy to answer your questions. But look, guys, this has been absolutely awesome. I've really enjoyed my first ever live Q&A on Instagram, on YouTube. Thank you so much for giving up a bit of your Saturday morning to spend it with me. Really, really enjoyed this, and I'll catch up with you all very, very soon. Thanks a lot for stopping by, guys.